Okay, well, good morning again, everyone. Thank you for being here today. I know everyone's probably got a lot more fun things to do on a Saturday morning than be here, but I do appreciate you guys coming and thank you very much. It's actually truly humbling to me when I see people show up. I always wonder if anybody's even going to show up. So thank you very much. And a special thank you to the Dallas folks. Thank you, guys. I don't know how many folks are there listening, but thank you for being here. We truly, truly appreciate it. Um, and please feel free to ask some questions. And we're going to jump into this today. Now, I have a few slides, but we're going to spend most of our time this morning with charts. But I wanted to go over a few things. And what we're going to talk about is using the price action, how you can use price action to do a little bit better job of managing positions. And this is one of the things that I use to enhance profits and actually help me to make sure that I'm trading the right trade at the time. So let's go ahead and we'll just get going here. And I had a question, and this comes from the Dallas group. I had a question that I want to answer before we get going here. And the question was about my 1/3 rule on credit spreads. Why do I have a 1/3 rule on credit spreads? So first, what is the 1/3 rule? Well, the 1/3 rule applies to any credit spread. And what I'm trying to achieve when I take a trade is I want that trade to provide me as close as I can to 1/3 of the spread in credit. So if it's a dollar wide spread, if I've got a dollar wide spread, I'm going to try and achieve at least somewhere around 30 plus cents in the credit. Now, the reason I do that, and let me tell you a quick story where this came from. This rule came from a real simple and real painful lesson that I learned many years ago. I got involved in a trading service, and this was one of those trading services that promoted, hey, we win 90% of our trades. We're super duper. We're the top of the world. Follow us. And so I got into it. And of course, I had heard, and I think this is fairly common for option traders, is we hear that, man, the place you want to be is you want to be in credit spreads. Credit spreads is high win, lots of high win ratios, and they're easy to trade and those kind of things. Well, I got sucked into this idea that we could trade these credit spreads and trade really far out of the money credit spreads because they had really high probability. And when you think about it, it makes sense. If you trade an option position, and let's say that option position has a delta of 10, okay? You're trading a delta 10 position. That means that trade or that short strike that you're in has about a 90% chance of winning or not being at expiration, not being in the money at expiration. So you have about a 90% chance of winning on that trade. And that made sense to me. If I could trade trades that were in that really high percentage area, I'm actually increasing my my potential win-loss, and it made sense to me, and they laid out a really good story as to why you wanted to do that. Now, what happened is that I was in this service for about 6 months, and every month this was just working. It was just the options would expire worthless, and I was making good, consistent money. It's boring because you put on a trade like this and you kind of have to wait for the month. It was boring trading, but it was working and it was making consistent money for about 6 months. And then we ran into trouble. Because we were taking trades, we were running trades pretty commonly where we were trying to achieve somewhere between about 10 cents to 14, 15 cents in credit on the trade. Now, the only way you can make that work, and obviously these were having somewhere between about 85 and 90 deltas. Excuse me, the other way, about 15. I should rewrite that, confuse everybody. So we had 10 to 15 cent trades here, and we were trading deltas somewhere between, so we have a delta value somewhere between about 15 and 10 was our delta. And because of that, we had pretty good trades. Now, the only way you can make that work, if you're picking up 10, 12, 14 cents in a trade, you've got to trade a lot of contracts to make that work. And so we were commonly trading pretty high numbers of contracts. And I didn't even think about so much of what this really meant. I didn't play this scenario out because it was just working. And so every month, you know, I was doing better and I was gaining confidence in this. So I was adding more contracts in on the trade. And then we hit one of those relentless markets. That market when it would just move against us really, really hard, and it wouldn't stop. And we've all been in that, right? Where we've been in that credit trade, and the stock or the market itself is just moving against us in a huge way, and it just is relentless. Well, we were in big positions. All of us in this service, we were in really big positions. And when it was moving against us, the answer from the guy running the service was, well, you had two choices. Just stick with the trade, see how it worked out, or to roll up and roll out. Now, when you roll up and roll out, what does that really mean in a credit spread? It means you're locking in a loss. Okay. And these were huge positions. And that was locking in a huge loss. That was his answer. Roll up and roll out and add more contracts to the trade. Because if you roll up and roll out, you're locking in a loss. You need to recover that. You add more contracts to the trade. Well, essentially what happened, the long story short, it's the biggest loss I've ever had in my entire career as a trader. It was a 5-digit loss, guys. This was the most painful experience I've ever been through. Okay. And what it ended up doing is the service was out of business in, within about 30 days of that happening, because virtually everyone in the group went broke. I mean, it busted them out. So they broke their accounts. The service went bye-bye, as you might imagine. And that's where this came into play. Now, after I got done licking my wounds and kind of recovered just a little bit, I started studying this a little bit more and did a little bit deeper thinking into why this failed so horribly. And it really comes down to what we're collecting in the credit. If we collect 10 cents, okay, on a dollar wide spread, that means we have 90 cents at risk. Okay. And we've all had those trades where we think it's a perfect setup, and then there's something in the news and it gaps the stock against you or moves the stock against you. Well, what happens in that situation is you can have winning trade after winning trade over here. You can have a 90% win-loss ratio. And at the end of this month, be at 0. Because you do all of this work over here to capture this gain for month after month after month. And then it wipes you out in one trade. And so the idea behind my 1/3 ratio, or my 1/3 credit, is that if I take a trade, let's say we do that dollar wide spread, and I require at least 30 cents minimum in taking that trade, well, that means I have 70 cents at risk. So in this trade, I can recover from a full loss, because we don't ever want to take a full loss. And if we're managing our trades properly, we shouldn't take a full loss all the time. But we all know in a credit spread, a news event or something like that can move against us really, really quickly. And we end up with that full loss every once in a while. Okay. Well, in this scenario, I can recover that in about 2.5 trades. Okay. But if I'm trading a trade where I'm getting 10 cents on that trade, the full loss is going to require me to do 9 trades just to break even. I have to win on 9 trades just to break even, and in full wins just to break even on that trade. So when I take a credit spread, I'm looking for that 1/3 spread because of that rule. So for example, let's say it's a $5 wide credit spread, well then I'm looking for that $1.60. It's $1.66 is the perfect spread. I want somewhere around that $1.60. And I'll tell you honestly, this is very hard to achieve. Unless we get lots of volatility in the market, it's hard to achieve. So I have some rules around that I follow, and I try to get as close to that 1/3 as I can. Now I'll tell you honestly, on a $5 wide spread, if it drops below $1 in credit, there's not a chance I'm going to take it. I don't care how perfect the setup is. It doesn't really matter to me, because I know it only has to take one of those, and now I've got to work really, really hard just to recover. So what happens in those trades is it's just a simple math. If we collect enough credit to make the risk worthwhile, that's why I put those trades together, and that's why I want to use that 1/3 rule. So hopefully that kind of explains that situation, why I have that rule, and why I'm so strict about holding to that rule. It just doesn't matter how beautiful the chart is, how beautiful the trade setup is, anything like that. If I can't get the credit to offset the risk that I'm taking in the trade, I will not take that credit spread trade. So hopefully that answers that question. If you have any more questions on that, let me know. And I do want to kind of keep to this subject. If you have questions on other things, let's deal with that after we get through this subject. So one of the things that is really important to me, and you guys probably heard me say this before, I believe price is king. And what we do as traders oftentimes is we focus on everything but price. We spend all of our day trying to create the perfect scan, or we spend all of our day trying to create the perfect set of indicators that's going to point us to the 1 or 2 stocks that we should trade today. And the fact is, that's a fantasy. That doesn't work. It never has worked. I spent years trying to prove that I could do it, and found out that it doesn't work. And it's a common story that you hear among traders that have stuck around for a lot of years. They feel like they wasted a whole bunch of their time trying to chase around that elusive, golden ring out there that just is not there. So when I say managing trades and things and improving trades based on the technical or based on price action, it's because as technical analysts, we have a little bit of an edge in our technical analysis if we work really hard at doing that. And there's some steps I think that are important to make this work really well. And the number one step is something that I think people miss most of the time, is they don't evaluate the overall market condition. You see, we want to trade every day. We believe there's money made in the market every day. We know that. And we know we have this idea, unless you're a day trader, if you're a day trader, you kind of have to work every day in the market to make your bones. But as a swing trader, position trader, you don't have to trade every day to be successful. In fact, what's more important than trading every day is that we trade quality trades rather than a quantity of trades. That we stay really consistent and we recognize when the market is just not providing good quality trades. And we modify our trading to that market condition. And so I actually put a class together. If you guys are interested, you can go to, for folks for Dallas that may not know this, or anybody else that's listening that's new, you can go to my YouTube channel, just search Right Way Options on YouTube, and there's a class in there called Market Condition, Evaluating Market Condition. And I would recommend you go through that on how I go through the process I go through to evaluate market condition. Also, you can just subscribe to my YouTube channel, because every morning I put out a video. It's just a real brief 10, 12-minute video going over the market condition as I see it for the day, preparing for the day. And I do that every single day. I mean every single day. To me, it's as important as breathing. I have to know what the condition of the market is. What are the pitfalls? What do I have to watch for before I go to the market? Because it helps me in how I approach the market that day. And so do that pre-market, or you can do it after the market close if you want, kind of evaluate the indexes. But I'm always looking and always evaluating. I mean, really constantly evaluating the market condition and how I should be approaching my trading for the day. And it's a step that I missed for years. Okay. I missed it and I missed it and I missed it for years. I would, and I'm going to show you a really good example of why you want to pay attention to this. So you also need to be working on your identifying trend of a chart, support and resistance. Those are really, really important. And if you focus on those key things in the price action of a chart, it's going to help you a ton. So if we study that price action, we can start exploiting the clues that are right there in the price action. And we can do it with either stock trades or option trades. So here's that slide on evaluating market condition, the things we want to do. And here's the thing I think is, it's supposed to be a little bit humorous in here, but one of the things we do as traders is we're often fighting the market. We don't realize we're fighting the market, but we're fighting the market. And we're feeling like the market, doggone it, the market's just picking on us. I get into the trade, the president makes a tweet, the market falls. Get in a trade and the stock does something weird and it falls and stops us out and then goes back up. But what we're not doing is we're realizing that we might be fighting a bad trend or a bad market condition. And so some of the things that you want to look for, how many days has the market been moving up? I actually count days. If a market or a stock is up 5 to 7 days, I am literally focused on that price action because I expect a pullback or a consolidation to start at any minute. That means I need to be thinking about taking profits, means I need to be thinking about how to manage that trade, because I'm always watching that price action and evaluating the market condition. And if you look at most stocks up 5 to 7 days, plan on a pullback or a consolidation to occur. Are we above or below key levels of support? Are we in a consolidation? What's the support and resistance tell us about the direction of the trade? What's coming up? What's in the news? What's on that economic calendar or the earnings report that could move this market around? How about the futures? What are they indicating? Did you check and see what happened around the world last night? The things that might be affecting our market here today. And we've all seen markets that are exuberant, or they're overly fearful, or just plain confused. And we have to plan our trading around that market condition. And we need to adapt to change. Now, this is a chart, and I show this chart quite a bit, and I actually use this chart quite a bit in my day-to-day trading. Notice there's no candles on there. It's just 3 moving averages. I have the 3 EMA, the 8 EMA, and the 34 EMA. And the reason I do that is it's really easy to identify trend. Look how clearly that trend shows up. There's actually trade signals in here, and that's another subject. I can show you how to do that. I could literally make money consistently trading this chart without ever seeing a candle, because it shows me the direction of the market. Okay? And we need to adjust. You know, when you see a trend like this, this is the Dow Jones Industrial Average at one point in time. You see a trend like this, you need to be trading. You need to be active in the market. You need to be working hard to find those good quality trades and following that trend. But you need to adjust if the market changes, because one of the things that used to happen to me, and I know it's happening right now because I just did a coaching session with someone, and it's happening to them right now. Last year, they were just making money like crazy. Things were just working. Now, all of a sudden this year, they're questioning themselves, and they're questioning their ability to trade, because all they've really done is lost money this year. I used to call that yo-yo trading. It's what I used to do, where your account, you'd have periods where you just seemed brilliant. Everything was working. Your account was growing and everything else. And then I'd go through these long periods of drawdown where nothing worked at all. And I would question myself, and I would change things up, and I would do brand new things. And what's worse is often those drawdowns would be further down than the rallies, the moves up in that account. Okay? And one of the reasons for that is we're not adapting to the market condition. So when you start seeing that happen, you have to stop and adjust. You have to change. The old saying from Albert Einstein, doing the same thing over and over, expecting a different result, is the definition of insanity. And traders do that a lot, because we don't want to admit that we just want to keep doing what we've always done. We don't want to adapt to a changing market condition. Well, let me show you something. Here's that same 3 moving average chart. This is showing the Dow Jones Industrial Average today. You guys see a difference here? If you're wondering why the market why you're struggling this year, why nothing seems to be working, it's because of that. The market has not been providing a lot of great swing trading or position trading. We've chopped back and forth. And we know that we've had these really volatile swings, right? Everything can look perfect the night before, the day before, and you've been buying up stocks like crazy over the last day or two. And then the next morning it gaps down and cuts all of those off. Well, we're not recognizing that market condition, that it's changed, and we have to change with that market condition. We have to adjust to the new condition of the market. Okay. So, price action clues. This is an actual trade. I ended up closing this trade just yesterday in the position, but I wanted to show you what I'm talking about here on using the price action of the chart to enhance or improve your trades. So on this day, these pink lines that you see on this chart right here, those pink lines are price alerts. Those little lines right there. So I actually entered this trade on Procter & Gamble this day. Okay. And I had a 70, I think it was a 72.5 call. Okay, on that 72.5 call. And the stock started moving up and doing nicely, but I recognized this price resistance over here. So as we moved up into this area, I went ahead and sold an 80 strike call option up here. I sold the 80 strike. And right way options folks know I do this a lot. It's one of the things that I do a lot of. I don't initially jump into a debit spread. Okay? If I'm confident in the price action of the chart, if I like the setup, I'm just going to take that directional trade, whichever trade that is, and I'm going to let the chart try to move in that direction. If it does move in that direction, that's when I start considering the management of that trade, how to enhance or to hedge the position. So as this is moving up into here, it's holding up, strength, everything is going good. I'm selling the 80 strike. Now, the way this trade worked out, and they don't always work out this perfectly, but what happened on this trade is this crossed above 80 right over here. Okay, we were above 80 right here, and only a few days left to expiration, because expiration occurred like right in here, one of those days. The gap down, the move down here was a dividend payment. Okay, but because I'd sold that 80 strike on this, I was okay with that. How many out here would be okay if you have the right to buy something at 72.5 and someone pays you to buy it from you at 80? Everybody's okay with that, right? Buy low, sell high. That's what we want to do. We want to do that consistently, right? What happens, though, is people who sell call options against positions, they start to panic because they look at their account. And this was actually, I was at risk of being called away on this trade. So this trade showed as a negative in my account. The short strike did. Showed as a negative in my account because I was above 80. That means that option that I sold, I think I sold it around 40 cents. Can't remember for sure. But I sold it for around 40 cents just a few days before expiration. This was, I want to say it was like 52 cents. It would have been higher if there would have been more time to expiration. So I had lost money on that trade on paper. But see, I sold that 80 strike with the idea that it's okay to take it away. I want them to take it away. Take it from me. A lot of times we as traders, we're concerned. We think about our commissions. We complain about our commissions a lot in trades. Well, think about this. Someone is paying me for the right to buy the stock at a higher price. Now, it doesn't matter if you trade this as a stock trade or an option trade. The same thing works. You buy that position, let that chart move, and then think about enhancing that trade with that position. Okay? So I'm kind of leaning on the option side here. I know the Dallas folks are option traders, and leaning on that just a little bit. We'll talk about the stock position here in just a second. But what ended up happening is that 80 strike expired worthless. And I was really close to cutting this trade loose because we dropped below this trend. Every single chart that you see me trade is going to have a trend. And you're going to see all of my charts. I use what I call a naked chart. No indicators on the chart at all except price. Now, I will move, I do use indicators, but very few. And the very few that I use, I put on a different chart. Because the first thing I want to evaluate is what price is doing. One of the things, traps that I think a lot of people get involved in is they trap themselves into evaluating the indicator and they really don't look at price. We've adapted this idea from a lot of different places, and it's all over the internet, and everybody out there running different services and so, oh, if you're not using this indicator, you're absolutely out of your mind. Well, here's the thing I know to be true. I have never, ever made a penny from an indicator moving. I make money when the stock moves. But what's funny to me is we spend very little time looking at price action, and we focus all of our time on indicators and creating scans and all kinds of things instead of focusing on the only thing that really makes us money, price. So when I look at a chart like this, honestly, this is how I draw up my charts. You'll see a downtrend. I'll mark out that downtrend. I will not trade a trade. I will not go long down here, ever. Because I am not interested in picking a bottom. I'm not interested in fighting the market. Who moves stocks? It's not retail traders. We're not the ones moving these stocks. It's the institutions that are making the decision that Procter & Gamble is now cheap enough to be bought back up. The institutions start supporting that stock, and all I have to do is wait for proof that they are going to support that stock, and then I follow them up. No predicting here, none whatsoever. Now, I have a fundamental belief in, we've all heard that an uptrend is a higher high followed by a higher low. But I think that definition is a little bit lacking. Higher high, what we see a lot of folks doing, well, that's trending, right? And so they jump in down here. And it worked here, they made money. But what about when they did it here? We never know when this trend is going to be over until it's over. And so I never am interested in trading a trade that's below trend, if I'm going long anyway. The market condition is up. I'm not going to be trading a down trading stock. I want the stock to move up. I want it to prove support. The buyers will support that trend. And over, if you look at charts and draw that downtrend line on there, you'll see this pattern over and over and over. Stock crosses above, comes back, tests the support. Over and over and over it occurs. And then I will even wait. If I see a resistance area here, I will require the stock to break through that and hold it as support. And that's what I did over here. Now you may look at this and say, for crying out loud, you waited all of that time for this trade? Why did you wait all that time for this trade? Well, the trade I closed on Friday was for 78% return. That's why. And I made more money than that on the trade because of the short strikes that I collected premium on. That's why. I don't have to pick a bottom. I can make this kind of return, and I can wait for the trade to come to me. Wait for the stock to prove itself before I get into the position. There's no prediction in here at all. Notice what happened here. Whoops. On this trade, I marked out the trend. I saw this buy signal right here, that pop up. I didn't take that trade. And the reason I didn't take that trade is I'm seeing this pattern all the time in the market now. The stock moves up and pulls back and they produce a buy signal in here. But if it hasn't moved back over to trend, it sells right back off over to trend. Now, the good news is if you take that early trade, the majority of time, if you take that early trade, it will hold your price support here. But you have to hold through the pullback. And that's okay. I jump sometimes too early and catch that, and I have to hold through that pullback. But what I'm always focused on is trend and how close are we moving back to trend. It happens all the time. Stocks, for some reason, like to find their way back to the trend in a downtrend and an uptrend. They like to find their way back to a trend. So when we get too far away from a trend, if we have a stock trend is looking like this, and then the stock itself is has moved sharply away from that trend. You know, we consolidated here, we'd been moving up, everything was looking good, moved too far away from that trend, it consolidates here for a few days and a pop right here, there's a buy signal here. I often will require that to follow through the next day before I'd be interested in that trade. And the reason is those pops, those consolidations right here, or that pullback in that first buy signal that's quite a ways away from the trend yet, tend to be getting sold into lately. The stock wants to come back to the trend. So I'm really focused on that. So if I'm going to enhance these trades, if I'm going to do the best job with these trades, first I have to consider my entry. What's my entry like into the trade? Well, I want my entry to be I call it a low risk entry. I want that trade to have pulled back or consolidated, moved over to support. It's moving off of support. It's moving off of trend. And then I find my signal because my stop loss is going to be just directly below this level. I don't have a lot of risk in the trade. Hopefully that's making some sense to you. I'm staying really close to those price action supports and trends for my entries. And then I'm looking in the chart, always looking in the chart. Where's the next resistance? So if I'm buying this as a stock trade and I'm looking up here as just simply a stock trade, and I look up here and say, well, there's price resistance right here in this chart. If I'm planning this trade as a stock trade, if I enter this position, my stop loss is down here, I'm going to plan this trade with this idea in mind. Do I have the potential of making 2 times my risk in this trade? I can tell you as a stock trade, this would not have made sense. There's not enough upside potential to the next resistance levels unless you just assume that it's going to break right through to this level. Then there is. And you can do that if you're confident in the overall market, confident in the overall trend of the stock. Say, hey, overall, I think this has at least 2 times my risk in the trade, and you can take that position. But as swing traders, most people are thinking very, very short term. I kind of tend to think that short term to just a little bit longer. I kind of term those that go past 2 or 3 weeks as more of a position trade, where I'm in that for a little bit longer, and I plan my trades that way to give myself enough time in case this trade really does something special. I can stay with that position and go with that position. But the next thing I'm going to tell you is if you're in this trade as an option trade and the stock moves up into that resistance area, you need to be thinking about how you're going to manage that trade if this is the end of the run, if it's over. And that's why I like to do things like selling call options against the trade up here, getting that call option sold to hedge the position. I like to do things like exiting part of the trade. I'll take part of the position off at that price resistance. It moves up to the next price resistance. I'll take more of the trade off if I'm going to stay with the trade. Otherwise, I'm looking at those resistance levels as profit targets. Those places where I need to start thinking about taking some profits out of the trade. So I'm enhancing the position of the trade, enhancing the management of the trade based on the price action. I'm using the price action of the chart against the market. I'm actually utilizing the information here to improve my trade, to get the best result I can out of the position. So with the stock trade, you have to think about targets. You have to think about the ratio in the trade. I find a lot of mistakes when I work with individual traders as a coach is they're constantly taking trades that have very little potential of gain, and they're risking as much or more than what the stock is showing on the chart for its potential to gain. Okay, so this is a rule that I use, and you guys can write this down, keep in mind, and modify it however you want. I only buy stocks long. If I'm going long, I only buy stocks long that are at or near price support and trend. I want that stock price to have tested there, and I want to see proof. Sorry, I flipped that. Didn't mean to do that. I want to see proof that buyers are stepping in to support that price. They're pushing it up. They're actually actively stepping in. I don't anticipate them coming in. I don't try to buy the pullbacks just to buy the pullbacks. I'm buying their response to that stock. Okay? And if it doesn't set up that way, I don't trade it. I mean, literally, I'm so picky about the trades I take. It's more about quality of trade than it is a quantity of trades. If it doesn't set up the way I want it, I don't trade it. I wait for the next opportunity to trade. Question from Art, do new entry price levels correspond with closing gaps on the left of the chart? Or is that a coincidence? You know, it's remarkable when you look to the left. The reason this line is right here, I can show you on a live chart here in just a little bit. If you look at a weekly chart, this is a major resistance level throughout the charts. It goes way back for years. Okay, so price history to the left in the chart is extremely important in the trade. It shows us, it gives us clues. New highs, good question. I'll have to show you on a live chart what I do with new highs. If I forget, remind me, would you, Mary? How I deal with new highs and set that target out there. Okay. Don, this will be put on for all members. This will be put on the e-learning page for members. And I'm going to load this one because we have the Dallas folks here. I'm just going to load this one over onto YouTube when we're done. So it'll be on YouTube. In the Hit and Run channel, Right Way Options YouTube channel. So let's move on to this trade. And I'm not going to spend much time here. I just wanted to explain this trade. This was last year, but I wanted to explain what we did here and how we enhanced this position and actually made more money. Now, I was looking at a chart that's just showing beautiful trend, sticking, everything was just looking great. And we ended up buying this position right up in here. We went long Valero Energy in Right Way Options. This is an actual trade. We went long in that trade, and the stock it just kept going up and going up. It was looking great. And as it moved up right up in here, I suggested to everyone what we needed to do is sell the 100 strike calls. So we sold that 100 strike call, and I can't remember what we collected. It was a nice little premium because we'd moved up so nice. We collected the premium on that trade. Now, the reason I did that is 100, anything that's a big round number, tends to serve as support or resistance. So we're moving up toward 100, and I'm just saying, well, hey, we're clear down here. Our option is down here, what we own. Okay. So if it goes to 100, we're looking great. And I want to say it's like $1.10 or something we sold that for. So, hey, we get somebody to pay an extra $1.10 to buy the stock from us at $100. Let's take that. Let's do that. So we put that trade on. Well, the stock did just exactly that. As you can see, it rose up to 100 and then started to show signs of problems. Now, because we had this 100 strike, we didn't have to worry about the pullback here so much, because we had time on our side on this trade. If this just consolidated in here and kept going higher, we would have been called away at 100. No harm, no foul. Great trade. Walk away, dancing on your desk. Okay. But what happened here is this started to fail. Started to pull back, started to fail. So it was one of these days in here, and I want to say it was maybe this one or something, where I told everyone, let's close our long position. We took our long position off. But I said, before you do that, buy the 105 call option, call option. And what we did is we took this debit spread that we'd legged into, converted it to a credit spread, took our long risk off of the trade, and just let the price action do what it was showing us it wanted to do, is move down. So we took a 150% gain on this side of the trade, on that long option here. And then we took max profit on this because these expired worthless. So we had a 100% winner on that trade. Exploiting the price action of the chart. Letting the chart lead you to the trade and using the price action of the chart to enhance those positions. So let's, I'm just going to jump right to some live charts here, guys. And we'll take a look at something that we can look at some new highs or something along those lines. Does anybody have a chart in particular that they would be thinking of that might be, up there around those new highs? Let's take a look at maybe like Square or something. Okay. And we can look, if I go to a monthly chart, this is blue sky up here. There's no resistance up there. There's nothing up there that gives us a clue as to what a target might be if we were to buy this trade. Okay, here's one of those great examples. We pull back hard. There's the trend. We pull back hard. We get this first really big pop, and look what happens the next day. It sells off. So if you chase that trade right there, you're probably a little bit of pain going into the weekend on that position because it pulled back so hard. So if this turns out, if this were to rest now, for example, if this kind of bounces around here and goes sideways, holds on to this support level for a few days, I don't know what the candles would look like. There'll be all different places and sizes and stuff in here. If that holds in here, what I will do is I'll place a price alert on my chart, actually a little bit lower than that. I'll place it right across the tops of those candles. Because what I'm looking for is I'm looking for that candle that pops up through there. Those buyers really stepping in, pushing this higher. So I'll place an alert up there wherever you want to be alerted on that trade for the next potential move higher. Okay. And you'll see those pink alerts all over my charts because I use those every single day. And I've started coloring them pink so that everyone can see where they are. So if I'm looking at a chart like this and let's say I see a buy maybe setting up in here, and I know I've got no upside resistance up here, I've got blue sky. How am I going to set some targets? Well, one of the things I'll do, I'll shift this to a weekly chart. And then what I do is I grab a Fib tool and I mark from the last swing low to the last swing high. Okay, on a weekly. And then shift back to the daily. And now I have price targets up there. See how that worked? Now I have price targets that I can shoot for in the trade and determine whether or not that makes sense or not. You can see that the Fib tool actually works really well that way. You can right here. It held price support on the Fib tool. This served as resistance on the Fib tool. This served as support on the Fib tool. So it does work very, very well. So if we were to hold in here and pop up, then I can start looking for these targets up in here on the trade. Does that make sense, guys? So I will flip to the weekly, look for that last swing low to swing high, mark my Fib tool down, and then go back to the daily and look for those targets in that trade. Okay. Steve's mentioning Disney. You're going to look at Disney and laugh because I have this thing drawn up like crazy. And one of the reasons is because I kind of have a thing for Disney, I guess, because I got into this trend here and held this trade for 4 years. I made a lot of money on Disney, so I kind of have a thing for it. And I've been watching and waiting for this trade to maybe come back around for a long time. So if you look at this chart, you can see that I've marked the downtrend here. See my downtrend? I've marked that downtrend on this chart. I've also noticed that this big pattern has formed right here in the trade. Everybody like a weekly W pattern? That's kind of a big deal for me. I think that's a nice pattern. And so I want to pay attention to that trade. So with that in mind, this breakout that occurred right here, broke above the downtrend, is important to me. So I flipped this over to a daily chart, and you can see there's a price alert right there. Because it broke the downtrend. It's hard to see with all the mess on this chart. It's hard to see, but right here is that downtrend break. I can see that we are trending up. Okay, so I placed a price alert. Now, here's a really good example of what I was talking about. Let me take all these lines off of here, and let's just draw this up from this point of view. Okay, so let's take this line right here. Would you guys agree that that's a current price support area? Chart's kind of showing that, right? Current price support, like that. I think we could probably all agree that if we mark this up, that's current trend. All right. Now we know we got above price support, and what we're seeing is buyers. There's no sellers underneath that support right now. We've dipped down a couple of times, but we come right back up. There's really no sellers below that point right now. So I placed my trade alert right above this area, but I'm going to be really cautious about entering that trade here. Do you guys know why? Look how far we are from trend. Would it be, that's right, David, trend. Would it be a surprise if Disney bounced around in here or even pulled back to reach the trend before this actually goes up? I mean, look at the stock. It's utilizing the trend. So why would that just necessarily change all of a sudden? Okay. Yeah, Don, you always have to pay attention. Always have to pay attention to earnings. TC2000, I put the earnings right here on my toolbar. So I'm always paying attention to those earnings. So there's no rush. When I look at this trade, even though I have an alert up there, I did not trade this on Friday. It popped my alert. But I didn't trade it on Friday because earnings and because we're a long ways away from trend. And here's the cool thing about trading this way is there's no rush. We can see a trade coming ahead of time, a possibility of a trade coming ahead of time, and we can plan for it. We can wait for it to occur. Is it entirely possible that this reports earnings and Disney just takes off up here? Yep. And I missed the trade. Yep. And I'm okay with that. I have no fear of missing out on a trade because here's what I know is true. Even if that does occur, eventually Disney is going to pull back and offer me an entry into the trade, and I don't have to chase or rush into the position. I can take my time and plan my entry carefully into that trade. So I'm always focused on what support, resistance, and trend are telling me about a stock and paying attention to those very closely. Lilly was one that I see Bob S. brought up Lilly. And anyone from Right Way Options that would confirm this, I was talking about the possibility of Lilly long before Lilly took off here. And the reason is I was looking at it like this. Here's my actual markings on the chart. Now, if I pull this chart back to a weekly, I want you to notice how important a breakout this was. Now, I didn't trade this, and I should have. I didn't trade it. But when this broke out of a multi-year high, that's a weekly chart, let's go to the daily, broke out of a weekly high and then pulled back and started back up, you can expect a pretty good move out of trades like that. Okay. And you notice that I've got this one marked at these wicks up here. If I took this line and moved it down here, more off the price of the candles, that's the perfect support right there. We broke through, we came back and tested support, and buyers stepped in and pushed that chart higher. And notice the 100 up here is marked. The 100 is marked because that's the natural resistance target, the big round number. You get up into this area and a stock will almost always rise toward that 100. I don't know why it is. It just sucks it up there. It wants to go there. And there we go. We have the 100 hit. So am I upset that I missed this trade? Well, I'm not upset. I wish I would have been in this trade. But if I look at this chart, what I know to be true is when this rests or pulls back, there's going to be another opportunity to trade this. And I just have to wait for the next trade. So when a stock starts in that strong trend, something kicks it into high gear, breaking through a multi-year high, I want to know that. Now, I find these charts all the time because I actually screen through weekly charts. I do that every week. I go through charts, and when I say screen, I do it with my eyes. I'm not running scans. I flip through a watch list of stocks, and I'm looking for these big patterns. David Wright. In the meantime, while you're waiting, there's going to be other charts setting up. There's going to be other trades making those kind of moves, things that we want to watch. So, for example, Philip Morris. Now, if you take a look at the long-term picture on this, Philip Morris has got a lot of work to do before it really breaks the long-term downtrend. But down here at this bottom, we have a nice inverted head and shoulders type pattern. We break through that resistance. We see we try to sell off and the buyers take it back. We break up through this resistance level, push up, pull back, and buyers step in. So we're long Philip Morris right now. In the trade, you can see I've got this marked up as for potential targets. Target 1, target 2, target 3. And all of these correspond to right there, and right there. So if this trade starts working for us, if this starts moving up, and I don't expect this to move straight up here. Philip Morris is one of those that doesn't move real fast. But if it does move up and moves up into here, you can bet we will be selling a call option up here to protect our current trade, to manage this position and enhance the potential profit of the position. Because we know on a move up, there's a very good chance of a consolidation or a pullback. This one will profit while we're waiting for this to find its legs and move on up. That's right, Linda, the eyeball scan. And that's the way I look at charts. I run very few scans. I look for charts and I build a watch list of what I think are quality charts, charts that are trending. And then almost all of my trades come from those charts. And one of the things I'm seeing right now, guys, this is just for everyone out there. One of the things I'm seeing right now is a lot of these consumer defensives are moving. Here we have Philip Morris. Take a look at, we've made some good money here recently in right way options on Coke. Consumer defensive. I think what we're starting to see is I think we're seeing a rotation from institutions. They're starting to pick up some of these big old blue chips, which may be a clue to some of the troubles that we're having in the market. Take a look at PepsiCo. We've made money in PepsiCo. A lot of these consumer defensives are showing strength. And even in stocks that you don't normally see things like this, like Kellogg's. Look at this big break, this move up, and this big breakout that just occurred here on Kellogg's. And buyers stepping in there. Something's happening here in Kellogg's. Now, I won't expect Kellogg's to be just one of those stocks that just rip higher. It won't be that. But I'm seeing a lot of those defensives coming up. Thank you, Steve. So we're seeing a lot of those things coming up, and it's just a little bit of a clue that there might be some issues there. One of the reasons that we are holding some other trades in these positions, we were looking at things that were trending and moving up. So we're in like XLF holding a basket. See the big downtrend break? We're looking for a whole longer term rally in the financials here. This still has to get through this resistance level in this chart right here. See that resistance level right there? We've got to get through that. But if we can blast through there, we should be in pretty good shape on this trade. So what we're dealing with right now is we're just dealing with the fact that we broke this downtrend. We're holding an uptrend. So pop up through here, and we're going to be golden on that trade, taking that little bit longer term look. So we're holding a basket. Leaps can be really handy on those stocks that you want to, hold for long term, Ralph. We did that. I really recommend, if you're going to do something long term, make sure there's a good solid trend. So for example, we had a trade back here in Microsoft. There was the entry in Microsoft, and we held that for a 99% return up in here using a leap option and selling calls against the leap options, what we call a fig leaf trade. Instead of a covered call, you use a leap option and then sell calls against it like you would any covered call trade. We made a 99% return trading this from December 2016 just into August of 2017, trading it up into there in right way. And then we've traded this several times. In fact, we made a really nice trade on this just recently. And because Microsoft tends to like to rally toward earnings. And so when we get around earnings dates, we look for opportunities to get into a few stocks and pick them up and make earnings plays on. We did the same thing with Apple this year, or this quarter. We traded Apple up into earnings, and it moved up. Took a long time, but it finally moved up, and we took a nice profit on that. So we're just using the price action of the chart. And by the way, if you look at this on a weekly chart, I mean, you don't get a sexier trend than that. That's about as pretty as they're ever going to be. So what I recommend if you want to use leap options is make sure that you're looking at a longer term chart, Ralph. If you're thinking of a long-term trade, look at a weekly chart and make sure that that weekly chart is proving trend. If it's proving trend, then you can get into that leap option and do a pretty good job with those. Yeah, Steve's been holding Costco. Whoops. And what a beautiful trade that's been. There's that weekly on Costco. Can you guys, I mean, all you got to do is draw some lines on here, mark this up. How about that for a beautiful support level? And notice that the buy signal just presents itself. Once you start drawing up a chart, the buy signals just present themselves. It's right there. It's not hard to spot, not hard to see. Held that big round number of 200. We broke through 200, pulled back. Held that big round number of 200. Let's go to the daily. Here's that 200 area. Broke through 200, pulled back. Held that 200 area. See my price alerts on here? I do exactly what I tell you I do. There's the breakout. Held that 200 area. Moved on up, pulled back. Wait for that entry, buyer stepping in at trend. Look at this. It's not hard to trade when we follow the price action and exploit that price action for those better positions in management, whether it be stock or option trades. So that's been just a beautiful trade, and Steve's been talking about that one for a long time. And what a great trade that's been for him and for a lot of folks. And it's just following the price action. Doesn't require anything fancy. So here's what I want to kind of close up with, and I'll take some questions, but I kind of want to close up with this idea. If you've been struggling as a trader, if you've been frustrated, if you've been watching your account just slowly implode, I call it a death from 1,000 paper cuts, where you're just slowly bleeding out. You never take really big losses because you trade conservatively. First thing you need to do is you need to evaluate that market condition. Get yourself a chart like this. Look, by the way, look at how beautiful this trend is on this chart. You don't even need anything other than this chart to be able to say, hey, that's a chart I need to be paying attention to, right? Now compare that chart to the Dow. If you're not evaluating the market condition and adjusting your trading to the market condition, you can have some trouble. You're going to experience a lot more losses because the market's whippy right here. It's throwing us lots of volatility, lots of whippiness. But if we focus on being really strict on the trades we take and follow a good process of entering those trades at low risk entry points, we have good opportunities. Yeah, Bob S. is mentioning only 2 times that have been really good buys for the Dow. I don't know if you guys can see it, since February anyway. It's right over here where we crossed up and held the 34 EMA as support and buyer stepped in. That was one time. The second has happened right now where we crossed up and we did have a little pullback right here and we're moved up. Twice this year only. That's the only periods that we've really been healthy in that entire chart. So do that evaluation of the market condition. And if you need some help with that, just subscribe to my YouTube channel. The videos are free. I don't put any ads on it, anything. I don't make any money from those. Okay. So it's not like I'm, hurry up and run over there and subscribe just because I'm going to make a ton of money. That's not what it's about. Everything I put on YouTube is free. Okay. So, subscribe to that and utilize it if you find that to be helpful, because I do that morning preparation video every single morning that the market is open. Just taking an unbiased look at the charts. Now, we'll do that here in just a second. The next thing is to mark up those charts. Get those drawing tools out and start marking up trend, support, resistance, all of those different things on the chart so that you're making sure that you are paying attention to what the chart is actually showing you, both the indexes and the stock itself that you're thinking about trading. This chart is the 3 exponential moving average is the green line. You can make it any color you want. Nothing about that makes any difference. 3 exponential moving average. The 8 exponential moving average is the pink, and the 34 exponential moving average is that orange. And see, here's the thing. I'll have people say, well, what do you think about this chart? And we'll pull up that chart, over here. Maybe it's somebody's asked me about maybe Goldman Sachs here. Okay, Goldman Sachs breaking downtrend, moving up. And we'll look at a chart like this and say, see where this changed? See where this became positive? All of a sudden, we stopped making lower highs and we started a process of making a higher low. We broke above that 34 EMA. Notice the 34 EMA turning up. So this pullback that's happening right now in Goldman Sachs has an opportunity of setting up a trade if it holds. But this chart can show us very, very clearly and really quickly, are we on the right side of this trade or are we fighting it? So do that evaluation. It's really simple to do. It only takes a second. And it helps so much in putting you on the right side of the trade. Yeah, that's right. It's been short. And now all of a sudden, it's reached that point where it's cheap enough and the company is probably worth enough that institutions are saying, hey, it's too cheap. It needs to be bought. Interest rates are going up. They're going to be making more money. And they're starting to bring this stock back around. So that's when we get a chance to identify that and then just ride along with the institutions supporting it. Okay. So it's really simple to identify, to give those really clear, hey, we're on the right side of the trade, we're on the wrong side of the trade in these positions. I mentioned we went over my trade in Procter & Gamble. Let's look at Procter & Gamble. Can you see the change here? This was my entry into P&G right over here. You see the change? It's easy to spot. It doesn't take any genius to do that. You don't need a scan for it. You need a list of stocks and you need to just flip through those stocks to find those good trades. Okay? And then always remember the bigger picture of a trade. If we take Proctor over here, and I told you I was going to pull this back and show you, there's that line and why I finally took the profit on it. I didn't want to, but it was too nice a profit for me. It was simple trade. I had well over $3,000 in profit in this little trade. And so I took it on a Friday, went to the bank, and you can see this is just a big long area where there's been lots of congestion and resistance. We get all of these different touches to a chart. Okay. You can see them in here where we respond around those price levels. And that's important to take note of in a chart. And we run right up there, and I'm going to be thinking about taking those gains. Because I know this to be true. If this pulls back and holds this trend, if it consolidates across here, comes back to trend, and then pops through, I just have to wait for the next entry into the trade. Any questions? Let's see, Wesley, from a high overview level, would you be able to elaborate a bit more how you use the interaction of the weekly and daily charts in different time frames? I sure will. This is an exercise that I do pretty much every week. I've gotten into a habit for years. I sit down on a Sunday afternoon after I kind of get all my work done, my lawn's mowed, and I've done my errands and things I need to do. And my relaxing time is when I sit and look at charts. I pour something to drink, I sit down, and I just flip through charts. Now, what I'll do is I'll pick an index. I do this all the time. I'll take like the diamonds. I'll throw this over, and TC2000 is great for this. If you guys don't have TC2000, you might want to consider it. I can get you a discount link if you're interested in TC2000. But I pull up the diamonds, I have to click one button, and I bring up a list of everything that's in TC2000. And then I just flip to a weekly chart, and I start going through that list. Now, I mentioned just the other day to everyone, we should start watching IBM. You guys see that in IBM? We've held a secondary support level. We have that W-type pattern starting to form here. We're still under a major downtrend here in the stock. But I'll drill into a daily chart here and show you what happened yesterday in IBM. IBM's starting to pick up, and this is a shorter term downtrend here. Starting to pick up. It's not ready for prime time yet, not ready to buy, but something may be changing here. And I found it by looking at the weekly chart. So same thing here, Pfizer. We found Pfizer. Anyone from Right Way Options can, if you wouldn't mind mentioning on here, I've been talking about Pfizer long before it broke out. And there was the alert on the trade. And you can see on this chart, there's that weekly big breakout. Notice that all through here, the whole way up, while we weren't getting through this level, all of our lows were rising. Pressure was building on this to break, and then this occurs. We pop through resistance, we hold it as support. Here's one of those examples where it didn't wait to come all the way back to trend. Too much pressure on the stock, and it popped and went. So on this trade, you wouldn't have had to take this first buy signal to been a winner on this trade, right? You could have waited for a follow through to see if they're going to actually buy this up from here. Wait for the follow through on that trade to get in. Doug, yes, they have a really good library of training videos. I mean, huge, massive. I can get you a link. I taught a class, This is for anybody that's interested, and I'm not trying to sell this. Let me get you a link though. I taught a class. I told them I was doing this class. They gave me this link. And it gives you $25 off. That's all it does. It's you know, I think the gold package for a year, it comes in with the coupon. It's like $274 or something. So it's one trade. And what I'm going to be doing here really soon, as a matter of fact, I may work on it a little bit this weekend. I'm going to start, I get a lot of questions on this. I'm going to start a series on YouTube on how I use TC2000. So you might want to watch for that. Mary, I did that explanation. Did you not catch that? Yeah, where I used the Fib tool, we're up there at new highs. I used the Fib tool, went to the weekly chart. I used SQ. By the way, 3M is a trade that we've been talking about, hit and run candlesticks and right way options. And I actually brought this up to Rick in the trade because we had this long weekly downtrend here. We crossed over and then we started to hold in here. And so members have made really good money on 3M here recently on this move back up, and it's just setting up for more upside. Okay, let's take a look at that really quick again. SQ, I was looking at SQ and I said, well, if we look at a long-term chart on here, SQ is blue sky above. So how would I set a target on that trade? Well, one of the things right here, this pop up and pullback, if this holds in here and then shows buyers stepping in, how would I trade that trade if that were to occur? Well, what I would probably do is I would go to a weekly chart here on SQ. Okay, and I would take the my Fib tool, okay, my Fib drawing tool, and I would mark the last swing low to the last swing high. Okay. And then if I go back to the weekly, or excuse me, the daily, I have targets up here. And what I pointed out before is that how well this worked in the chart before. If you look right here, the Fib tool is marking out this area as support, and we reacted there well. It marked this area as resistance, and that worked. It marked this area as support, and that worked. Marked this area as support, and that worked. So as long as we're getting those good marks in here that this is actually laying out the chart pretty well, then I can look at these up here for potential upside targets if a trade were to set up in this area for that position. I'm using the Fib retracement. And you can see here, let me show, this is how I have mine set up. You don't have to, you don't have to set up yours like I do. But I'm not looking for every Fib number out there. I'm only looking for these around the middles areas. So that's how I have mine set up. You can take a screenshot of that if you want. And I don't use any of the extensions or anything like that. I just mark up. I keep it simple. So I'm looking for those major areas. And these, heck, I don't need these. I can shut that one off. I don't need that on there. I just need these numbers here because I'm a swing trader. Okay. Make sense? Hope so. Any other questions that I can help with? I don't want to keep you guys forever here today, but Nigel's saying he loves TC2000, but you don't think their current videos are great. Yeah, that could be. I haven't looked at their. I mean, no, they have a huge library of videos, but I haven't looked at their updates for the new software. So a little bit, Scott. What Scott's talking about is an indicator that I kind of brought to the room a while back, a couple years ago. It's called volatility stop. And it helps people identify support, resistance, and trend. Okay. And you can see in this chart, it showed that there was resistance above this price. And we could see that right in the chart. Now, it depends on where the signal comes in, where my concern for that resistance entry is. I consider anything below the red volatility stop. By the way, let me just give you guys a setting on that if you don't have it. There's nothing fancy about it. It's not a parabolic SAR. It's using average true range, and we use a period of 10 days, 10 period, and a multiplier of 1.5, and it places these little dots on the chart. Now, all it's doing is marking out support, resistance, and trend. That's all it's doing. Okay, that's not a buy-sell indicator. Price is your buy-sell indicator. But I brought this to the room for the exact purpose of helping people see support and resistance. So with this trade, do I have to respect this resistance up here? Yes, absolutely have to respect this resistance. That's what the chart's showing me, that there's resistance there. So should there be some concern on that? Absolutely, there should be concern on that. Okay? But I have a trend. How do we make a trend? We consistently break that last high. So if I have a good solid trend and I like the way the chart's laying out, I will sometimes take those trades below that vol stop, but not always. I'm really picky about the ones that I do. Okay. Now what I want to point out in this trade, you say, well, why would you take that below the volatility stop? I want you to recognize the fact that my stop loss on this trade was right here. I had very little risk in the position. Okay? I look for trades where I have very little risk in the position. And I had a trend and a buy signal supporting this price. So make sure you have all of those things lined up if you take those trades below that resistance. But remember, trends tend to do that. Now, if you want to have a higher win-loss ratio, I mean, you really want to just hone in on getting a higher win-loss ratio, volatility stop can help you with that by being pickier about the trade. You take no trades that are below that volatility stop. You only want to take trades that are holding above that volatility stop. Take a look at Costco as an example. A little pickier in the trades. Stays above the volatility stop. You can see those moves. It's marking out support, resistance, and trend. Okay. Do I look at short trades? Yeah, absolutely. We do look at short trades. Let me first explain. We look at short trades when the market's showing me downtrend. If you look at the markets right now, is the Dow in a current downtrend? No. Is the SPY in a current downtrend? No. So until the market starts downtrending, I'm not going to trade short trades most of the time. Okay, unless I find that really good setup. We had one here recently in LMT. Whoops. Let me go to this chart. I identified this big breakdown right in here. We broke down through here, and then we rallied back up to test that as resistance. And at that resistance point, we had a failure pattern. We had that hanging man, bearish engulfing right here. And so we put on a ratio spread trade. Our short strike was right here at 340. So we were way out of the price range here on that trade. And then this did just what we'd hoped it would. It held resistance, moved on down, and this trade expired for a max profit. So there are times if I have a really good setup in a long market, I'll take those. But I want to stay moving with the direction of the market. Okay, I don't like fighting the market. I'm not big enough. I won't win. You won't win that fight. Just trade with the direction of the market. It's easier. And maybe it's because I'm just lazy. But I'm not going to fight it. My experience tells me, and I have a whole bunch of statistical data to show, that when I trade with the direction of the market, I win more trades. When I fight the direction of the market, I lose. Simple as that. So I try to stay with the direction of the market. Okay. And just the other day, do you guys remember when this was? I can't tell you exactly what day this was. I think it was over in here. Let's go to a short-term chart. It was somewhere over here. We were talking about signals in trades, and I suggested to folks this would be a pretty good time to pick up a short trade for a hedge using the cues. And it wasn't just a few minutes after that. Somebody said back, man, if I'd have followed your trade there, I'd already be up $100 on the trade. And all this is, if I take this chart and go to that volatility stop, turn it on a 15-minute, you can see the trades show up here. So red turns to green. We move up and pull back and hold support. There's a buy signal long. Green turns to red. We rally back up to resistance and fail. There's a short trade. And every single one of these after that, where we rally up to test and fail, are potential entries for short trades. We get back over here on the rally side. None of this in here I would trade. This is chop. We're flipping back and forth. Red turns to green. We pull back, hold support. Here's your buy signal. Morningstar pattern right off of price support for a winning trade. Same pattern over and over, different time frames. Works just the same. Volatility stop can be great for helping you see and identify good trading patterns. Now, before we go here really quick, I want to take just a second and I want to look at the markets. And I want to tell you that I really love the fact that the bull stepped in and pushed us back up, but I want to also issue a little bit of a caution on what we're looking at. If we looked at this chart and we're really objective as to what's going on here, we have to admit that is a resistance level right in here. Okay, here was our current trend, and we failed through that trend, and we're rallying back up right into resistance. Okay, so don't be surprised if we see some struggle or even a failure in this area. Be careful loading up thinking that we're just going to blow higher here. That's not proven yet. If we look at the diamonds, that's true. If we look at the SPY is in a little bit better situation because it did hold this level of support. Just a second, my doggone tool changed. There we go. It held this level of support. Okay, and we pushed back up, and the way I have trend marked right here, we're holding onto that trend. So there's a higher probability in the SPY that we come up here and attack this all-time high in the SPY. Keep in mind, we still have this price resistance right here, and we could fail right in that area. So watch that close. Okay. If we look at the Qs, similar situation to the SPY in the fact that we held on to a major support level right here. We held on to it, responded back, but we also failed through the uptrend, and all we've done so far is rally back to price resistance. So we have to be a little bit careful here. We could see some bouncing around, some pushback, or even failure here, and it shouldn't be that big of a surprise. And what Steve is saying is IWM is concerning, and I agree. IWM is a little bit of a concern. We have failed up here 3 times to get through. And then we broke down through support, and then we're just making some kind of a choppy little rally back up to the bottom of that trend. Here's that current trend right here. A failure here could happen at any time. So there is some concern here in the market. There's no reason to just be running for the hills, but there is a reason to be pulling back on your trading activity and watching and waiting. And there is reason to be thinking about taking profits on trades as we push up here. We'll have to wait and see what this means. And I can't tell you what it means. I can't tell you if we rip higher, if we collapse from here. I can't tell you. I can just tell you that there's reason for caution, reason for a little concern. And my biggest worry, the reason I bring this stuff up is these last couple of days where we've had this nice move up. What tends to happen a lot is those without much experience or whatever, those trying desperately to get some of their money back that they've been losing lately, they're buying like crazy on these 2 days, when they really should be thinking more about taking profits and reducing risk to the market. We're doing exactly opposite. And they race in, and if we happen to get a gap down on Monday, there's going to be a lot of people hurt by chasing into that, not recognizing the condition that we're facing here in the market. Now, my hope is that we pop on out of here. You know, that we see the markets just take off, that everything starts to work out, that the SPY moves on up, takes out that high, moves up here, tests this all-time high. That'd be awesome. But I'm certainly going to be careful as we approach that level. Okay. Well, hey, everyone, I want to thank you guys for being here today. I hope you got something out of this. I hope it made some sense to you in looking at that price action that way and kind of investigating how we can improve our trading by really focusing on the price action of that chart marking up that support, resistance, and trend, and really visualizing what that chart is trying to tell us and trading around, okay, that price action in those positions. Okay? So if we can utilize that chart a little bit better, focus more on that price action, focus on that market condition, we can improve our trading results, and we don't have to be yo-yo traders anymore, where our account moves up for a while and then we give it all back, and then it moves up for a while and we give it all back. We want to stop that cycle by improving ourselves as a trader and reading the story that's being written every single day in the price action of the chart. All right. Hey, I want to say thank you to the Dallas option group. Thanks for being here today. Hope you got something out of us. We'll look forward to you guys being in the room. And feel free to take advantage of all the information that we have here. Ask questions. We love to hear from you. Members, thank you very much. I just truly am humbled that people show up on a Saturday for a class like this. Thank you very much. Everyone take care. Have an awesome, awesome weekend. We'll talk to you all soon, bright and early, Monday morning. As a matter of fact, with the morning preparation video. So take care, everyone. We'll talk to you all soon.